Question of the day. Can you quantify the value of a financial advisor? It's an interesting, juicy topic that I know a lot of you, PFR Nation, wrestle with this every single day. But truthfully, other people wrestle with this too. Other consumers, other retirees, and truthfully, other financial advisors try to wrestle with this. So we're going to be tackling this on today's episode 106. And we're going to be referencing Advisors Alpha, which is the most widely cited studies out there. They've been doing this for 25 years. Vanguard, the king of the race to zero fees, have been doing an annual study to try to quantify this as a percentage of your investments to try to determine what the value is of a comprehensive financial advisor. But I know what you might be thinking. Kevin, you're a financial advisor. How could you possibly talk about this without extreme bias? Well, I can't. And if that's a problem with you, turn off the episode. Because truthfully, I am more biased today than I was 17 years ago when I started as a financial advisor in 2008. But if you're still listening, let me actually give you a little spoiler alert. I think Vanguard is overstating the value of a financial advisor for you all, PFR Nation, okay? Not the general public, not everyday Billy, Joe, and Bob, but for PFR Nation, I believe they are overstating it. However, I actually think Vanguard misses the mark by omitting what I believe are two key areas that a comprehensive retirement-focused advisor can add for you. So we're going to dive into this episode today. Let's have some fun with it, okay? But first, I need to talk about something, okay? Listen, as a Gamecock, okay, as an SEC football fan, my Gamecocks are off this year. And I know I talked a little bit about the Gamecocks early in the season, how we had a lot of hype and, we had arguably the best quarterback in the league. That didn't play out so well in 2025, but it's okay. I'm still an SEC football guy, even though the NIL has kind of spoiled it for me. I'm a little bit of a, I think I'm a little bit of a, sort of a bitter old man, if you will. I'm kind of old school in this regard. I don't like how the NIL has sort of made college sports and now even high school sports basically like a professional sport. It's a show. Okay, I'm not a huge fan of what's been going on. But there's a big story in the SEC. Lane Kiffin, for those of you that know what's going on, Lane Kiffin, coach of the Ole Miss Rebels, and he has a long history in the coaching carousel. He was a Nick Saban guy. He coached at Alabama as the offensive coordinator, went on to other jobs, and then landed this gig in Ole Miss. And he has them at 10-1 with the opportunity to win a national championship at Ole Miss. That doesn't happen. But guess what? LSU snipes him away, takes him away, signs a $91 million deal to go to LSU, coach LSU. But here's the catch. He can't even coach the Ole Miss Rebels to see if they can even win a national championship there. So he's leaving a school where he has the opportunity to win a national championship this year, and he's going to go leave for a job where he could potentially have a better opportunity to win a national championship. It's a little backwards to me. Truthfully for me, I get it. You're going to say, Kevin, well, he's got to do what's best for him and his family. Okay. I think there's this lack of loyalty in today's sports, both professional, college sports. Okay. And I think it's an issue. What does that have to do with retirement planning? You might be feeling pretty loyal to your employer. Okay. You might be feeling, hey, I've been here for a long time and I owe it to them to stay another 2 or 3 years of working. But have you seen the news a little lately? Firms all across the board, all different industries are laying people off at a pretty alarming rate. Okay. And this has been happening for the better part of 18 months. PPP loans have been kind of, running dry a little bit. And now you have inflated payrolls and these companies like, we can't afford to continue to pay all these people what we're paying. So we're going to do some layoffs. We're going to do some cuts. Okay. So I guess my point in this, do you have an exit plan if that were to happen today? Okay. Because at the end of the day, most people retire earlier than they anticipated. I think the percentage exactly is over 40% of folks retired earlier than they thought they were going to retire. So if you're 60 years old, 62 years old, and you're maybe thinking in your mind, you know what, you're going to work until you're Medicare eligible at 65. That's kind of the most common thing I hear. Do you have an exit strategy? Have you stress tested your plan? If something were to happen to your job today or next year, do you have an exit strategy? Are you financially independent? Okay. And if not, what do you need to do or what can you do things that you can control? Not things out of your control. Like, hey, I'm going to try to swing and hit a home run on the next NVIDIA. Like, I'm not talking about that. I'm talking about things that you can control. Tracking your budget, tracking your investment strategy. Okay. Looking at opportunities to minimize your lifetime tax bill. thinking about your Social Security timing or the timing of your pension, okay, or your savings rate, getting aggressive over the last 1, 2, 3, 4 years of your career to potentially aggressively pad some of your non-qualified assets, some of your brokerage assets to bridge the gap until you start Social Security. Things that you can control today, start doing those. Even if you're feeling super confident about your gig, there is no loyalty anymore anywhere. Okay. And this example of Lane Kiffin leaving Ole Miss is a perfect example of that. There is no loyalty anymore. And it's a shame. For me, like I said, I'm old school. I like the rivalries back in the day. As growing up as a kid, I love the rivalries, but there can't be any rivalries anymore because nobody stays longer than a year or two. Okay. This is the carousel back and forth. Everyone's chasing the money. And I get it. Everyone's got to do what's best for them. But it's an unfortunate day and age that we live in today. I'm sad for my kids that they're not going to get to experience true sports rivalries like I did growing up. I'm very fortunate that I had that opportunity. But my point on the retirement planning front is always have an exit plan, always have a plan B, and stress test your retirement plan earlier than you think you're going to potentially work. Okay. And it may not even just be a loss of a job. It could be health changes for you. Maybe you're not physically able to do this work anymore. I see this all the time with practicing. Okay. Or, maybe it's not your health. Maybe it's a spouse, or maybe it's an aging parent. And now you need to take some time off work or potentially leave work in order to care for those individuals in those loved ones. Okay. All right. That's my little rant about Lane Kiffin. Love to hear your thoughts. So if you're a college football fan, I would love to hear your thoughts on the Lane Kiffin thing. Do you think he was in the right to leave, to go to LSU? Of course he had that right, but do you like that move? Do you feel like he should have stayed at Ole Miss to try to win a natty right there? Ole Miss, you have the opportunity. You're going to make the football playoff. What's going on here? The grass is always greener, and I get that. But either way, I'd love to hear your thoughts. If you're a college football fan, tell me what you think. All right, so let's talk about the Vanguard study for just a second. Okay, so first and foremost, I mentioned at the very beginning, I think Vanguard is overstating the value. And let me kind of just tease ahead. Vanguard, let me kind of just give you the high level. Vanguard quantifies, I think there's 7 or 8 different categories of things, quote unquote, things that a comprehensive financial advisor should do for you. And they quantify this as up to 3% a year on returns, net rate of returns on your portfolio or more. Okay. So it's up to 3% or more. Okay. So it's hard to say this is the actual percentage because again, Vanguard gives ranges on all their different categories. So they might say, investment allocation anywhere from 0 to 1% a year, et cetera, et cetera. So it's hard to figure out exactly the percentage for each individual because everyone's situation is different. Not everyone has a pension. Not everyone has, a nice healthy mix of taxable, tax deferred, tax free. You might be heavier on the tax deferred and lighter on the tax free. You might be heavier on the tax free and lighter on the taxable. Okay. Everyone has different situations. That's why I think the ranges, it kind of makes sense. You need to have ranges in there. But their study says up to 3%. But I've said at the very beginning, I believe that they're kind of overstating this for you, PFR Nation. Okay. Now, why do I feel that is the case? All right. Well, there's really one primary reason. I am learning who you are. Okay. I'm learning more about you, PFR Nation. Okay. Obviously doing this podcasting and YouTube thing, I'm talking into a microphone. Or recording a video and you're watching this, you're consuming this. And we've had an insane year for growth. Like I just got my Spotify, end of year, what is it? The Spotify Wrapped. Cause we post primarily on Spotify, then it trickles out to everywhere else like Apple Podcasts, et cetera. But according to the Spotify stats, we grew 999% this year. Pretty good. So golf clap for all of you PFR Nation. Thank you for listening. Thank you for the loyal listeners that have been listening for a few years. And then even the newbies that are just jumping on the bandwagon. And by the way, if you are new to the show, just a little plug on this one, episodes 100 through 103, I did a little breakdown, just a high level breakdown of the first 100 episodes that I recorded and just one high level key takeaway from each of those. So if you kind of want to get caught up to speed on some of the philosophies that we have, just listen to those. Just listen to those 4 episodes and that'll kind of get you up to speed to where we are now. So yeah, we're seeing a lot of growth and that's great. But I think the point of me saying all this is now I'm actually learning a little bit more about you because a lot of you are reaching out. A lot of you are now clients of our firm, of my financial planning firm. And by the way, I do this for a living every day. I mentioned earlier, I'm a licensed advisor. I've been practicing for 17 years. So I do this on a day-to-day basis, but the whole podcast ecosystem is new for me, but I'm learning who you are. You guys are reaching out. A lot of you are CPAs, you're doctors, you're lawyers, your entrepreneurs, your executives, your engineers, like you're smart people. Okay? At its core, you're respected in your fields. You're not underachievers. Okay. And also, plus, many of you are golf lovers like myself. So, we all know golfers are a little bit smarter than the average individual, right? But I say all this because a comprehensive financial advisor, absolutely, up to 3% or more, I would 100% agree with the Vanguard study. Okay. However, there are some things in the Vanguard study that I believe PFR Nation, because you're consuming our content here in the show, you're probably consuming other content related to retirement planning. You're reading, you're digesting all of this out there. You probably have some of these things buttoned up where a comprehensive financial advisor is probably not going to add as much value to your situation. Okay. So that's why I mentioned that earlier, is that I kind of disagree with Vanguard's blanketly saying that out there. That's why I like the ranges, because it could be anywhere from nothing up to a certain percentage. And that makes sense. But let's kind of use that 3% as the benchmark. And I'm going to go through the Advice Alpha study at a very high level. Okay. Because what I want to do is I actually want to get to the two things that I believe they're missing. Because I think those two things, in my opinion, are really the core of why a lot of smart individuals hire our firm. Okay. Especially as they're transitioning to retirement and then executing retirement. So why don't we start with the Vanguard study? I'll link it in the show notes. And I'm going to go through this at a high level. I'm going to talk about each of these things. Like I said, they've been updating this for 25 years. So I was first exposed to the study, I think back in 2011-ish, 2012. And it kind of looks the same, but definitely there's been some evolution to their study. And so they have 8 different categories of things that an advisor could potentially add value for. So I'm gonna just go down the list, okay, in no particular order, other than this is how Vanguard is laying these out. I'll talk at a very high level what each of those categories means, okay, for those of you that are not familiar, and I'll kind of maybe give some examples here and there of things that can be done in that situation and how a comprehensive financial advisor can add value. But then, like I said, we're going to then go into some of the key points that I believe add so much more value over and above everything else they're talking about here. So why don't we dive in to the Vanguard study? And I'm going to take a sip of my coffee here. My Santa mug. Was this the Santa mug? Yeah. Here's my one of my Santa mugs here. One of many. My wife buys an insane number of coffee mugs. And she's one of those seasonal coffee mugs. And, so I didn't buy this. So, don't make fun of me. I did not buy this, but I like drinking out of it because that is my name on it and Santa. And there might be a little eggnog in this coffee. Let's kick it off. Number 1, Vanguard's Advisor Alpha strategy, suitable asset allocation using broadly diversified funds and ETFs. And guess what? And I'm going to talk about the percentage that they state, Vanguard's percentage. They say somewhere over 0%. So they don't even give a range on this one. They just say somewhere over 0. So it could be 0.01, could be 0.1, could be 1, it could be 2, could be 3%. I think this kind of depends on what your situation is and how far off from a suitable asset allocation makes sense to you. But I will say this, with PFR Nation, even you are included in this too. Anyone can devise a financial plan. You can go and use Bolden, one of the DIY financial planning tools, and devise a nice little asset allocation to say, here's the percentage of stocks, bonds, here's how much exposure I want to large cap US stocks. Here's how much exposure I want to have to emerging markets, international stocks. So there's one thing to know what you should do, but then there's another thing to actually do it. And that kind of comes into play a little bit later on in bullet point number 4, which we'll talk about later on. But suitable asset allocation, I think one of the arts of this one is kind of knowing not only your risk tolerance, but also your risk capacity. Because I think it's very easy to kind of fall into the trap of hey, this is what Bolden says my investment allocation should be, or this is what Vanguard says my investment allocation should be based on my age. And age is certainly a factor, but there are many other factors, which we've talked about on the podcast many, many, many times before. So it's not the only factor. And I have clients that are retired that are the traditional 60-40 portfolio, 60% stocks, 40% bonds. But then I also have clients that are 100% in the stock market. And the outcomes there between 100% in stocks versus a 60-40 is dramatic. If you compare the rates of return, that could be a difference of 300 or 400 basis points, which translates into 3% a year or 4% a year more with those differences between 100% stocks and 60-40. So which one's right? There is no right answer. It depends on your unique circumstances, your unique financial plan, your unique goals, your unique risk tolerance, your unique risk capacity. But that's number 1 for Vanguard. They think this doesn't add a lot of value, which I don't entirely disagree, especially for you PFR Nation. You're savvy enough to kind of, do a little research, do a little due diligence, understand the efficient frontier and where your portfolio needs to fall in that efficient frontier. And then you can build a portfolio with bullet point number 2, which is the investment selection. And I think a big part of this one is, especially for Vanguard's angle, is minimizing fees. One of the cool things I saw with the Vanguard study was back in 2001 when they started this, the average internal fund ratio was close to 1%. I think now it's close to 0.3%. So that's come down about 70 basis points over 25 years. That's going to continue to come down as folks kind of transition out of the old school mutual fund model into newer ETFs, exchange traded funds that are a lot more cost efficient, a lot more tax efficient as well. But the investment selection pillar, Vanguard says, anywhere from 0 to 100 basis points, which translates into 1% a year. 100 basis points equals 1%. So I'll try to use percentage as much as can, but Vanguard, they say basis points, so I'm reading that. So 0 to 100 basis points. Yeah, I think this makes a lot of sense. I mean, I review portfolios all the time, and I'm looking at, what their allocation is to, let's say, a large cap US stock or an international stock fund. And I'm just looking, expenses aren't everything in my opinion. Okay. Sometimes it does make sense to buy a slightly more expensive fund if you're comparing it to the benchmark for specific reasons. Okay. Maybe it's risk management, right? Or maybe it's tax efficiency. But I've reviewed portfolios where they have an expense ratio internally over 1% a year, where we know we can build that portfolio for probably less than 25 basis points or less than 0.25% a year. So that alone, we have the same allocation, like we said in bullet point number 1, with a different investment selection, a little bit more tactical investment selection, and that could potentially save up to 0.75% a year. So yeah, I would kind of agree with the Vanguard study here, 0 to 100. But again, PFR Nation, I know you are savvy and you guys are very, very keen on lower costs, which I am as well. I like lower costs, internal expense ratios. So if we can suppress those internal costs as low as possible, I would say 0.3%, that's probably a little bit higher than the average that we would see within our model portfolios. Our model portfolios are probably closer to 0.15% a year all in. So we can add value there by simply just maximizing the cost effectiveness of the investment selection itself. Okay. Number 3 we'll throw in here is rebalancing. In Vanguard, they quantify this as up to 0.12% a year or 12 basis points a year. Rebalancing simply is, okay, we've got bullet point number 1. We have a suitable asset allocation. Let's call it 60. Let's use the 60-40. So 60% stocks, 40% fixed income. Let's say over the course of 12 months, now all of a sudden, let's use 2025 because we're in 2025. Let's say your stock allocation is maybe slightly higher because US equities, international equities have outperformed bonds. Bonds, though, not a terrible year. This is what I was talking about earlier this year, bullish on bonds. A lot of people kind of laughed and said, you're nuts. Well, guess what? Bonds over 7.5% over the course of this calendar year, cumulative rate of return. Why is it 7.5%? Or why is it over 7% in general? When the coupon rates are probably 3.5% to 4%? Price appreciation. Why do prices go up for bonds? Because interest rates fall. So the same is true in the opposite side of the spectrum. In 2022, when interest rates skyrocketed, the prices of bonds went down. That's why I said bullish on bonds in 2025. Even though it was a little scary, there was some liquidity crisis with the treasury markets. I was like, ooh, I started to lose a little sleep over that one because I was very shortly after I did the bullish on bonds episode, but bonds over 7.5% a year. This is not a recommendation to buy bonds. Okay. This is definitely not a recommendation to buy bonds just because I'm saying this. Nothing is a recommendation, period. We're not having a conversation about your situation, your goals. I'm just talking, this is just high level. Rebalancing would say, if bonds underperform stocks in a given year, that means instead of your 60-40 portfolio being 60-40, now your portfolio might look a little different. It might be 70% stocks, 30% bonds. Not because you did something specific with your portfolio, but the markets moved the prices in different directions. That's why you want to be diversified in general, is that asset classes move in different directions at different times, and you don't want to have all of your assets moving the same direction at the same time. Okay. Because that's, then you're going to be in trouble. If you go through a downturn, especially if you're retired, you're taking money out of the portfolio, you might run into some problems. So if we're now 70-30, okay, emotionally, you might feel, oh, stocks are doing great. I'm gonna go all in on stocks. Interest rates are probably going to come down again in December. Let's go a little more aggressive. Rebalancing says, no. We want to take the 10%. Let's say, thank you, stocks. Let's take 10% off the table and let's reposition those into the fixed income to get back to the 60-40 target allocation. This is why having a suitable asset allocation, having a suitable investment selection, and then rebalancing that, these all work really in tandem together. In my opinion, this is just simply called DERP. You know how I like to call DERP? Discipline, unemotional, repeatable process. So if you have a DERP, you're kind of covering all three of those, all right? So rebalancing at its core. And how frequent do you rebalance? Our firm, our general process is once a year at the beginning of the year, okay? However, we do reserve the right to rebalance throughout the year depending on how volatile markets are. Like in 2022, we rebalanced more than once. 2020, rebalance more than once. 2018, rebalance more than once. So you need to have the framework of what the frequency of how much you're going to rebalance. In my opinion, rebalancing too much can actually hurt you. And actually studies have shown this, is over rebalancing is actually not as effective as maybe a once a year or twice a year type of rebalancing. I hear a lot of people say, well, quarterly rebalance, look what my model portfolio is doing, or look at my advisor's doing, is rebalancing quarterly. What you're actually going to do is you're going to hurt your assets that are flying up in value. Like if you rebalance stocks this year, that probably limited your upside. Okay. So it certainly does manage risk more, but you're going to hurt your upside more. And is that worth it in the long run? My opinion is no. And that's why we have the standard once a year, but then we do reserve the right to rebalance more than once a year. All right. Number 4, this is big. Behavioral coaching. Vanguard says up to 200 basis points or up to 2% a year or more. That right there. Okay. If you hired a comprehensive financial advisor who's worth their fee. Okay. And it's good at what they do, and they can handle the things that we just mentioned, that DERP. They can also handle some of the things that we'll mention here in just a second, and the things that Vanguard did not mention, which I'll talk about at the very end. That's worth its weight in gold. And if they can manage behavior, okay, manage your behavior. I'm talking to you, PFR Nation, even, because I know some of you are too smart for your own good. And you know it too. And I've had people hire me literally because of that. They'd say, you know what, Kevin? I know too much. Like, I know too much about the markets. I had this really smart CEO of a bank, and he hired me because of that. He said, Kevin, I know too much about capital markets and what's going on behind the scenes with lending and with default rates. And I just know too much. And it results in me trying to time the market. And it results in me getting my behavior, letting my emotions take over. And because I've been practicing for a little while, I have so many of these stories. And I've talked about a lot of these stories on the podcast before. We work with this one couple and love them to death. They're great people. Okay. But when the wife retired, the wife's the one that had the larger asset pool. The husband had more of the pension set up. So the wife, she kind of let the husband do the CIO deal, CFO, CIO deal. So he was the investment manager. He was the financial planner. He's a smart guy. He is a smart guy. But when she retired back in, 2021 into 2022, you remember all the volatility that was going on. We just had a great year in stocks in 2021, but then we had a downturn in 2022. Well, guess what? Because she was early on in retirement, he was super afraid of that sequence of returns risk fear, which is legit. Anyone who retires and that first 2 to 3 years, you're kind of like, wait, and you're like, hopefully we don't go through a major sell-off or a bear market, but you never know. You can't control these things. So you need to have a plan and process. I did an entire episode on sequence of returns risk and hedging that. I think it was somewhere in the early 90s episode. So check that one out if that interests you. But he decided to move the entire portfolio to cash in 2022. And when I met with them, when they engaged me at the end of 2024, he had been sitting in cash. I mean, look at that. The opportunity that kind of already left them. 2023 was a phenomenal, over 20% a year in stocks. 2024, over 20% a year in stocks. And then it was this fear of like, now if I invest the portfolio, now if I deploy the portfolio, what if we go through a downturn? We're in an election year. This was last November, December timeframe when we were onboarding them. What if we went through a recession or a downturn because of the new administration? Not because they disagree with the new administration's politics, but they were just like, anytime you have uncertainty with tariffs and things like that, we could go through a downturn. Those are all legit, but those were all behaviors. That was letting emotion and what he thought was going to potentially happen with the market get in the way of his decisions. So it actually came to the point where they almost didn't hire me because he was uncomfortable with deploying even a 60-40 portfolio, 60% stocks, 40% bonds. But, I did my thing. I stayed firm because I wanted to help them out. I knew what she was going through. She wanted to fire him. So she was like, Kevin, I want to hire you because I want to fire my husband. He was afraid, though, because I don't want to just move all of my cash into the market after 2 consecutive years of positive 20% rates of return. I don't disagree with the logic there. But again, we go back to DERP, discipline, unemotional, repeatable process. And anytime it involves your money, we could be emotional with it. So what I did is I said, you know what, Jim, let's do this. Instead of moving all of the money into the market, let's deploy the fixed income today. Let's create a fixed income strategy that aligns with the cash flow needs over the next several years. So let's deploy that 40%. And then the 60%, let's move 20% each month for the next 3 months, unemotionally, starting in December. And that's exactly what we did. So we got him into the 60-40 allocation. Boom. Now we're sitting there at the beginning of March. He's feeling pretty good. But then guess what happened? Liberation Day. Woo, you better believe that first review with them, he wasn't super happy. Their portfolio had dipped quite a bit. Yes, we had a little bit of a bump at the end of last year and the beginning of this year, but all of that was erased in Liberation Day. You better believe those conversations, those were legit conversations, okay? And I had to, again, manage their behavior and get them to stick to the plan. Now listen, PFR Nation, you might be thinking, yeah, Kevin, I'm not emotional. You're emotional. We're all emotional with our own money. That's why we need a third party. You think a lawyer represents himself in court? Absolutely not. She's going to hire a different attorney. Okay. Same kind of thing. And I could go down. I have a laundry list of stories just like this. Some good, some bad. One of my favorite ones was me talking someone, a very smart university president, off the ledge at his first year of retirement. He retired in February of 2020. He wanted to completely bail out of the market. He wanted to completely bail out. Coached him, stuck with the plan. That alone, those conversations, and there were a series of calls with him, he and his wife at the beginning of 2020, probably 8 or 9 different phone calls from February through April, got him to stick to the plan. That alone right there, that probably saved him 30% on his portfolio. That takes care of an advisor fee for pretty much an entire relationship. So these things happen. And that's why I think the Vanguard study is spot on. And they're saying up to 200 basis points or more. I believe this is where Vanguard nailed it. I think it could be absolutely way more than 2% a year if you average that over the duration of lifetime. It could be less, but it could absolutely be up to 200 basis points or more. And I think this is probably one of the key pillars in this entire study that I believe that I'm so convicted now, practicing for 17 years, that we help our clients stick to that DERP. Number 5, asset location. I'm going to kind of actually run through this one pretty quickly. Asset location, we've talked about this before. Own the right investments in the right places. Don't own the wrong investments in the wrong places, okay? And what I mean is from a tax standpoint. You have tax efficient investments and you have tax inefficient investments. Don't own your tax inefficient investments in your taxable accounts. That's really the bottom line. Own those in your tax advantage accounts, tax deferred accounts like IRAs, 401ks, Roth accounts, okay? So try to do this as much as possible. That adds value, according to Vanguard study, anywhere from 0 up to 0.6% a year. Okay, number 6, this is what I'm talking about here. I like this one here. Tax efficient retirement strategy, up to 100 basis points or more, up to 1% or more. This is my bread and butter, and I 100% agree with this one. I like where they're going with this one, up to 100 basis points or more. However, that's for the general population. You PFR Nation, you guys are tax expert. You guys, because this isn't rocket science. You can dive into content. You can dive into, traditional education. You could even take the CFP, right? You could even take the Retirement Income Certified Professional designation, 2 designations that I have personally. You could take those as a consumer. You don't even need to be a licensed professional. Now, you may not be able to use the marks, but that's okay. You can take the education. You can learn the things that we're talking about. You could go to ChatGPT and learn all the things we're talking about. So is it 1% or more? Maybe for some people, but for you, PFR Nation, I think this is kind of muted a little bit, okay? Just because of your knowledge and your expertise on sequence of withdrawals. When do you tap your taxable? When do you tax your tax deferred? When do you tap your tax free? But I would also say this kind of lines up to legacy. what legacy goals you have and charitable goals, because that also weaves into what accounts you spend during your lifetime versus what accounts you leave to your children or to charity. Very important. But up to 1% or more a year, I would agree. Maybe less for some of you, maybe more for some of you. Okay, depends on the tax makeup of your portfolio. If you have 100% of your assets in tax deferred accounts, there could be a lot more value added there. Okay, if you have a nice blend of taxable, tax deferred, and tax free, maybe a little bit less value added. Okay, so there's a lot of nuances that go along with that, but I think that's one of the big key value adds that I do believe Vanguard got this one right. Number 7, total return versus income investing. This one is pretty muted. This says anywhere above 0. So they're kind of not really seeing a lot of value on this one. I think this one is probably this was a little bit more prevalent when I was getting started in the industry, like from 2009, 10, 11, 12, 13, 14, 15, when interest rates were super low. But we had this period of time where prior to that, folks in the 80s and 90s, they were enjoying double-digit returns on things like treasuries or CDs. And so people had this preconceived notion that, hey, I'm going to just live off the quote unquote interest. Well, once interest rates fell to 0 in that time frame that I mentioned from 2009 to 2016, they couldn't find that yield. So they were like, oh, we need to find total return. We need to focus on total return, meaning income from interest income from bonds or dividend income in addition to price appreciation. So I think it's kind of shifted, and this has become definitely, it was a newer concept that post 2008, a Great Recession, but it's now a little bit less. I think now folks they're getting it. They can't just go all in on preferred stocks and expect to earn a 7% a year and just do nothing, or, earn 9% a year on their treasury accounts. And then they can just chill on their portfolio. They don't have to worry about investing in stocks. Not anymore. You need to have stocks as part of your allocation, because people are living longer and we have longevity and inflation, all that good stuff. Okay. Number 8, last but not least on the list, tax loss harvesting. Makes sense. This one, this actually surprised me. Vanguard says up to 1.5% or more. So, they're saying there's a lot of value add. I think it depends on the size of your taxable account. So if you have $3 million and 2.5 million is in a taxable account and 500,000 is in a tax deferred account, this is probably right. This could add a lot of value over time, where you essentially turn your unrealized losses into realized losses, and you can use those then realized losses for tax purposes, offset gains in that current year, in the future, use up to $3,000 a year to deduct against ordinary income. Lots of value add on that front. I would also kind of throw in there tax gain harvesting. You might be in a situation where you have 0% capital gains brackets. Maybe you do want to reset your cost basis during that time frame and fill up that 0% capital gains because you're not going to pay any taxes, and now you've reset the cost basis. However, you need to be careful with that because it could limit your ability to do Roth conversions by doing the gain harvesting, because that does add taxable income. So you got to be a little careful with that. Don't just do that just because you're going to pay 0% long-term cap gains, because it does impact other areas of your tax strategy in retirement. But again, up to 150 basis points or more, I think it kind of depends on the size of your taxable account. If you have 0 in taxable assets and $3 million in tax deferred, this is not going to add any value because you cannot tax loss harvest in a tax deferred account. Okay, so then the summary here is Vanguard says up to or even exceeding 3% in net returns. So on its surface, the general population could benefit from hiring a comprehensive financial advisor. And I would say could benefit hiring a comprehensive financial advisor because not all advisors are comprehensive financial advisors. Some advisors are not focused on tax efficient retirement income planning. Some advisors are not even doing any financial planning. They are just strictly trying to manage investments, and they're trying to beat out the market. They are not even investing. They need behavioral coaching. I'm not even going to lie. But someone I talked to recently, their advisor timed to the market in 2022. So they were that personal CFO story, but it was an actual licensed professional. And I've seen this, trust me, many times in my years. And that's why when you're hiring an advisor, you need to ask the philosophy. Like, are you trying to time the market and think you can beat out the markets, or are you trying to earn the markets? Okay. Our firm, we just want to earn the markets. We want our clients to get the rate of return that they deserve based on the amount of risk they're taking in stocks and bonds. Like, very simple, keep that simple. But then the tougher part is in implementing that from a behavioral standpoint. Well, this advisor was managing the portfolio based on what they thought the market was going to do. And in 2022, they moved it all to fixed income. Now this client's sitting in a bunch of treasuries and money market accounts that are, sure, they're earning 3.5%, 4%. But this couple, they're in a super high tax bracket, and they're paying state income taxes in California. This is one of the most tax efficient moves they've made. And they never deployed those funds back into the market. So they've been sitting over 2 years, now close to 3 years, without being invested properly in the stock market. I mean, that's awful. So sometimes it's not even clients that need the behavioral coaching. Sometimes it is advisors themselves. So I think there's a lot to the study. I think it does a decent job quantifying the value of an advisor, a comprehensive advisor, okay? Not one that is stock picking and trying to beat out the market. So I think there are two things that are missing here. I think the first one, you're going to know where I go with this, and this is the hidden alpha of advanced tax planning, not just touching the surface. I think Vanguard does a decent job. Order of withdrawals on the retirement income side. I think that makes sense. But how are they coordinating alongside things like IRMA, right? Or Affordable Care Act premium tax credits, or tax efficient legacy planning, or charitable planning, charitable giving, QCDs, charitable bundling, okay, with donor advised funds. I think the margin of error is so tiny here, and it takes a lot of time and effort and intentionality to get it right. Okay. So I think advanced tax planning, like thinking about Roth conversions, like, should I do conversions or not? Like, sometimes I think my value add is actually coaching people against doing Roth conversions, because Roth conversions have become so mainstream in podcasting and YouTube. It's like people just kind of think, I should be doing Roth conversions. I have a lot of tax deferred accounts. I should be doing Roth conversions. That's not always the case. So sometimes it's actually coaching people out of those strategies. So I think Vanguard is missing the mark a little bit on advanced tax planning, because if you really quantify that one, those numbers can be very, very, very large. It's hard to put a percentage on that one, because everyone is going to have different scenarios play out, and it kind of involves the old get out the crystal ball, tell me exactly how long you're going to live. We'll tell you how much value you're going to save in taxes. But furthermore, tell me exactly what the tax brackets are going to be for the next 20 to 30 years and your kids' tax brackets, and then I'll tell you how much value add. So it's hard. We could do modeling in our software. I don't want to throw out those numbers, because I think they were a little overinflated in the financial planning tools out there to say, this is how much value add you can add to your plan, but the numbers can be substantial. But I think there's a bigger one out of all of this. And it is the hidden cost of DIY financial planning. And that is the cost of time. What is your time worth? And I'm not saying don't do DIY because it costs time. Like, if you're listening to this podcast or watching this YouTube video, you probably like this to a certain degree. Like, that's one of my takeaways that I've been learning through this process of the podcasting journey and the YouTube journey, because like traditionally the first 12, 13 years of my career, I was working with folks that really didn't have an interest. So therefore they wanted to delegate. So those people we can absolutely add a lot of value to. And I think that 3% or more is very, very accurate. It's probably on the higher side of 3%. But I would say for a lot of the DIYers, you guys, PFR Nation, you all love this stuff. Like, you're eating it up. Like, if you can kind of get into your spreadsheets and do all the, stress testing and run the hypothetical scenarios of Roth conversions versus not, and managing different tax brackets, managing different IRMA brackets, managing different ACA premium tax credits, like, that might be something you really enjoy. But there may come a time, and this is kind of what I'm seeing, there may come a time where you're like, you know what? I'm kind of done doing this. Like, my spouse is getting pissed off at me because I'm spending all this time. Like, that was actually something that happened recently where someone hired us, a podcast listener. And if you're listening to this, hello, a podcast listener was lost in the spreadsheets and was spending a lot of time on this. And his wife said, I am so glad we're hiring you, because now my husband can stop spending 4 hours or more on staring at his spreadsheets on his computer every day, looking at retirement analysis. And I just kind of laughed at that, because I'm like, I think that's so true. I think this is why I get so excited about doing what I do, because yes, a lot of you PFR Nation, like, you listening, you guys are interested. You are, you're savvy individuals. Like I said, I'm learning more about who you are. You are well sought after professionals in your fields. Like, you could do what I do. Like, look, you could actually be a financial advisor, a very good financial advisor, I think, certain subset. But in retirement, I kind of think about this. It's like, is your time getting more valuable or less valuable? I think that's kind of the bread, like kind of the baseline of the question I asked myself today is like, what is my value? And this is kind of what a lot of advisors wrestle with. And this is what Vanguard studied. They're not bringing this up. It's like, what is your time worth? And I wrestle with this myself now, like, as an entrepreneur, and like making decisions around hiring and like outsourcing certain things. Like, this is a big thing that I think about is like, what is my time worth? And if I were to put a dollar amount on my time, I'm not going to do that right now, but if I were to put a dollar amount on my time, and then I would say, you know what, is this activity that I'm doing here, is this worth my time? And if the answer is no, I might consider delegating it. If the answer is no, but I love doing it, I could consider continuing to do it. So I'm not like saying don't DIY your retirement plan, but there may come a time when you're like, you know what, my time is worth more. I don't know how many years left I have on this planet. So you know what, I'd rather spend my time with my spouse or with my kids or with my loved ones or doing things I love doing, like playing some golf, right? That's for me. It's like, how many rounds are you going to have after you turn 60 in your lifetime? Like, I don't know what that number is. But each of those golf rounds is going to be worth a lot of value to you. And are you spending time lost in your spreadsheets or crunching the numbers or following the markets or delegating it to a comprehensive professional who can do this? And this is, like I said, this is where I think Vanguard misses the mark because they don't actually quantify this one. So we're going to try to do this. I might first ask you to do something fun. What do you believe your time is worth today? Or what do you believe your time will be worth in retirement? And I want you to think about a number, like literally just pick a number. And like, if you currently bill by the hour, like if you're an attorney, like you actually may have a number on that. It might be $500 an hour or $350 an hour. Okay. If you're a CPA, same thing. If you're an engineer, consultant, you might have a number already. Okay. If you're an entrepreneur, you might have a number. So pick a number. I'm going to hold you to that. Pick a number right now and then pause. I'm going to pause for a sec. Pick a number. Then I want you to do this math. I'm going to predict because what I know what's going on, and I've talked to a lot of you, PFR Nation. I'm going to say, let's say you spend an hour a week on your financial plan, on your retirement strategy. Okay, about an hour in a week. And it doesn't mean an hour you're like tinkering with things, but an hour reviewing things or listening to something or deciding if this strategy makes sense for your plan or not. Okay, let's say it's an hour a week. I'm going to start plugging in. So I'm going to call it 48 hours a year because I'm going to say, let's give you 4 weeks where you're totally unplugged. You're on vacation. You're not doing anything. Okay, so let's say 48 hours a year. Let's use that as the benchmark. If you said $350 an hour, your time is worth, and you multiply that by 48, that's $16,800 per year. Maybe you don't think your time is worth $350. Maybe you think it's worth $175. That's $8,400 a year. Or on the flip side, maybe you think your time is worth $500 a year or $500 an hour, I should say. That means you're spending $24,000 per year managing your own retirement plan. And of course, like I said, I'm very biased on this one, but I just want to encourage you, PFR Nation, to think about this. As you approach retirement and you go through retirement, what do you want to be spending your time doing? Like, this is one of the baseline questions that I ask every client that I work with. Okay, it's like, what do you want to be spending your time doing? And like hopefully you're talking about like, I'm going to take some trips with my family. I want to take my kids on trips and my grandkids on trips, or I want to, I want to go to Bandon Dunes and do a golf trip with my golf buddies, or I'm going to go to Scotland and play St. Andrews and hit up all those golf courses. Like, hopefully you're saying that. You might say in the beginning, you know what, Kevin, I'm loving financial planning. I'm loving retirement planning. Like, then more power to you. Do it. Okay. Because that's going to give you enjoyment. It's going to give you fulfillment. But if you're kind of like, you know what, it's something I feel like I have to do just because I just don't trust anybody else. I get that. I don't trust anybody. I'm very slow to trust people because I don't know. It's just, I think being in business for 17 years, it's just hard to trust people. So, but once I trust, then I let you in. Okay. And you may be the same way. And so I think, there is a fine line here. I don't want to belabor this point, but I think there is a fine line here of like doing something that might not be worth your time, but that you find enjoyment with, versus doing something that is not worth your time, that you feel like you need to do, but that you do have the capacity to delegate. And I think that's really the question that I think a lot of retirees need to wrestle with as they approach retirement. It's like, what do they want to be spending their time on? If it's not this, then they need to think about how are they going to delegate this? Because there are 200,000 licensed advisors out there. And this is why I did an entire podcast on finding a retirement-focused financial advisor, because not all advisors are created equal. Not all advisors are doing all these things that we're talking about here today. So certainly a comprehensive advisor could add up to 300 basis points or more, but if they're not comprehensive, then maybe not. or if they have too many clients and they can't really behavioral coach you, or they can't really dive deep on tax planning, that's a problem too. Because some of them might be great advisors, but they might just be trapped in the system. They might have to serve 500-600 people, in order to make a living. Like that's, in my opinion, I'm biased again, it's very hard to do. And that's part of why I went independent and broke away from the big firm, because I don't have the bureaucracy to deal with that type of thing. So I think at its core, this is, in my opinion, one of the biggest value adds, if not the biggest value add. Certainly you can look at behavioral coaching, you can look at the tax planning. I would say those are the core two that I would extract from the Vanguard study and say yes. The other ones, I think they're overinflated for you, PFR Nation. For the everyday consumer, not so much. And if you know someone who's probably not doing all these things that we're talking about here, refer them to our firm. We'd love to help them out. But even if you're DIYing and you're like, you know what, Kevin, I think it does make sense for me to delegate this. We'd love to help you. I mean, this is what we do a day in and day out basis. And we'd love to help you. And if you're interested in that, you can start with the retirement readiness questionnaire that's linked in the show notes, or just go to our website at www.imaginefinancialsecurity.com. We typically help folks that have saved about 1 to 5 million in that sweet spot. And we help them maximize their retirement spending plan, minimize their lifetime tax bill, and we're less about money. Okay. But I hope you found this valuable. I'm going to link the study, and I'd love to hear from you. What do you think about the Advice Alpha study? Do you think it's overinflated? Do you think it's underinflated? What do you think about the time argument that I just mentioned as well? What your time is worth? And I'd love to hear, like, literally from you all, when you think about being in retirement, what do you put a dollar amount on what you think your time is worth? I'd love to know what that number is and to see if I'm way off. Because like I said, I could go hire an attorney for $500 an hour or $350 an hour. So that's potentially a starting point benchmark. Because I think in retirement, we don't know how much time we have left on this planet. And when you're in retirement, you're probably in your 50s, 60s, or 70s. Your time might even be worth more. It might even be $1,000 an hour. I'd love to hear the number you came up with. So let's have some fun with this one and not take life too seriously. But listen, thank you all for tuning into this episode. Thank you for supporting the show. Thank you for the 999% growth we've had in 2025. That, I did the math, that is over 10x. And it's kind of cool because I read a book at the beginning of 2024. It was called 10x is easier than 2x. And that kind of like that title, I thought it was like a really clickbaity title, but I'm kind of seeing it. I get it. 10x was easier than 2xing the podcast. And then the YouTube, I mean, that's way above 2x. So thank y'all for supporting. Make sure to subscribe to the channel. Make sure to also follow the channel. Make sure to also subscribe to the YouTube as well. Because every single week, in addition to these podcasts, I'm also putting out a weekly YouTube specific video, specifically designed for you all, PFR Nation. So thank you for tuning in. And until next week, this is Kevin Lau signing off.